Hi, welcome back. This is Journey from the UIS Learning Hub, and this is video number 2 for Financial Accounting or Accounting 211. In this video, we will be going over T accounts, the logic behind it, and some terminology from the last video. In this video, we will be doing a brief refresher on categorizing different accounts, introduce the practices of double entry accounting, and the models that reinforce it, such as T accounts. So as a reminder, let's look back on how we can categorize different accounts. First, when we analyze a transaction, we want to determine what exactly is involved. We want to determine whether if it's an asset, and if yes, what specific account of assets, such as cash, equipment, supplies, accounts receivable, etc. Or we want to determine whether there's a liability involved, whether we're in debt to someone or we're promising to pay someone back later. If the answer is yes, the account will typically fall under accounts payable, but it can also be more specific, such as wages payable or notes payable. There's also the liability account unearned revenue, also known as unearned fees, which is when someone pays you before you actually provide the service. The third account we want to keep an eye out for is the owner's equity account. Is the owner of the company putting money into the company? If yes, then it's the owner's capital account. If the owner of the company is withdrawing money from the company, it's the owner's drawing account. Another account we want to look out for is the expenses. What exactly are we spending money on for the business? This could fall under accounts like salaries expense or utilities expense. Also keep in mind that an expense is incurred when an asset is being used. So if you buy supplies, you would not initially record it as a supplies expense until you actually determine how many supplies or how much supplies are being used. Otherwise, it just remains as an asset called supplies. The last account we want to look for is the revenue. When we make a sale or perform a service and receive something in exchange, revenue is involved. If it's a service you provided, it falls under the revenue account of fees earned. If you sold merchandise, it typically falls under sales. Please also note that the account examples on the screen aren't everything you need to know. There are other accounts you will learn about, but these are typically the most common ones. This slide is very important because you will be attempting to categorize and organize these accounts into things like T accounts and journal entries for the rest of the course. Also being used in the rest of the course is the double entry accounting method, which essentially is a method for recording financial transactions that will fall either under the debit side or the credit side, and keep in mind that both sides will need to be in balance with one another. So how do we decide whether an account should be debited or credited? Here are the rules on how to do that. If it's an asset or an expense account, we debit an increase and credit the decrease. If it's an account that falls under liabilities, owner's equity, or revenue, we do the opposite. We debit the decreases while crediting the increases. So for example, let's say James gets $50 in cash for selling a shirt. We know cash is an asset and it's increasing, so cash would be debited. Now that leaves the matter of what is credited. In this equation, we are also increasing our revenue, and by the logic of these rules, since the revenue is increasing, it's credited. Now with that logic in mind, we are introduced to T accounts, which are just ways to organize double entry accounting by showing what's debited and what's credited. So we start off at the top of the T account where you write out the specific account that's being affected. And from there, on the left side of the T account, you write the amount that is going to be debited, and on the right side, you write the amount that's going to be credited. So remember, the left side is the debit side, and the right side is the credit side. Let's try some examples so you can understand what's going on. Let's start with number 1. So here, Christopher gets $500 in cash for performing a service. When working on T account problems, we want to ask ourselves a few questions. First, what accounts are involved here? Is it an asset, liability, owner's equity, expense, or revenue? Once we've pinpointed the 2 or potentially more accounts, we want to specify the account. And after that, we want to determine what is happening to each account, whether it's being debited or credited. And then finally, we would draw out the T accounts once we figure out all that information. So here in this problem, Chris is getting $500 in cash. What does cash fall under? It's an asset. And what is the second account that's involved here? Is it an asset, liability, owner's equity, expense, or revenue account? It's a revenue account, since Chris is generating money as a result of his services. More specifically, it's the revenue account called fees earned, as it's a service that he's provided. And with the logic we looked at earlier, since an asset in the form of cash is increasing, it's debited. And since the revenue is increased, it's credited. Now, what would the T account look like for both of these? Take some time to sketch out the T accounts. If yours looks like this, you should be on the right track. Now that we understand the gist of T accounts, let's look at some more examples. So in number 2, Phil gets $500 from a customer for a service he hasn't performed yet. So right off the bat, we know that an asset is involved because we are gaining cash, but we haven't provided the services yet. And the wording of the problem signals that there's a liability involved because he hasn't specifically performed the service yet. This falls under the account of unearned fees, which is a liability account. So since we know that we're gaining an asset in cash, the cash account will be debited since it's an asset that's increasing. Meanwhile, we know we have gained or increased a liability due to the unearned fees account. So since it's a liability account, we would credit it since it's increasing by $500. And the T account should look something like this. Moving on to number 3, Damar pays his employee $2,000 cash as a part of their salary at the end of the week. What accounts are involved here? We know cash is involved, so we have an asset again, but it's going down as the result of the cost of being in business, which is also an expense. So here in this problem, we have cash and an expense involved. More specifically, a salaries expense is involved here. So cash is going down, which is an asset going down, meaning it's credited, and an expense is going up, so that means it's debited. And the T account should look something like this. In number 4, Jerry invests $5,000 in cash into his business. From the company end, we are gaining cash, which is an asset, so that means cash should be debited. But Jerry, the owner of the business, is also investing money into his own business, increasing the overall equity, meaning we credit the owner's capital account. Note that when the owner withdraws money from the business, we use the owner's drawing account, which is typically debited because the cash is going out of the company, meaning it's credited. In number 5, we deal with what seems like multiple transactions we have to make T accounts for. So let's try to tackle them one at a time. So Paul pays $28,000 in cash for a truck for his company. So here we're losing cash, an asset, meaning we would credit cash for $28,000. But we're also gaining or increasing an asset in the form of a truck, meaning we would debit truck for $28,000. Keep in mind it's still an asset and not an expense because we haven't technically used it yet. In the second part of the problem, we pay $10,000 in cash again, meaning an asset is decreasing, so we credit cash again for $10,000. Here, the transaction also hints at an expense as a cost of being in business. So we would debit utilities expense by $10,000 as we are increasing our expense account. To reiterate everything covered in this video, double entry accounting is essentially an accounting system that keeps tracks of accounts either under debits or credits. And throughout this course, you will be asked to analyze transactions to determine whether certain accounts will be debited or credited, and then asked to show it through T accounts or journal entries. These videos will serve mainly to cover the fundamentals of financial accounting, as being able to analyze transactions and categorize accounts is a large percentage of the Accounting 211 course.